The stock market can feel like a noisy room where everyone is shouting at once. It is not that there are no choices. The problem is that there are simply too many choices. Everywhere you turn, someone is promising a new fund, a new strategy, or a secret path to long-term success. When every option sounds good on paper, it becomes nearly impossible to tell what actually matters for your future. But after decades of watching the markets, I have learned that even small differences in how a fund is built can lead to massive differences in your bank account. Over time, these small gaps can grow into a difference of over $1 million. So it leads to the question that almost every investor asks sooner or later. If you could only pick one index fund to hold for the rest of your life, which one actually gives you the best long-term outcome? In this video, I am going to break down 5 of the most recommended index funds in the world. I will show you exactly how each one behaves over years of compounding interest. We will compare their returns, their volatility, their dividends, and their exposure to different sectors. And right at the end, I will reveal the one fund that stands above the rest. I will show you how this single choice can turn $10 a day into a portfolio worth over $2.2 million. This is a strategy that can eventually pay you over $6,000 in monthly dividend income. But before we look at the list, we have to understand why choosing the right one matters so much right now. Think of index funds like different types of vehicles. On the surface, they all look like they do the same thing. They are designed to get you from point A to point B. But under the hood, they are built very differently. Some are built for high speed, some are built for maximum comfort, and some are built for fuel efficiency. If you pick the wrong vehicle for the long trip you are taking, you are definitely going to feel it later. Index funds work the exact same way. They might all track the market, but how they track it changes your entire experience as an investor. One fund might own thousands of companies, including a lot of slow movers that drag down your performance. Another might focus only on the very biggest companies, giving you stability, but cutting off your growth. Then you have the funds that lean heavily into technology. These are great when the market is running hot, but they are brutal when things pull back. These differences do not seem like a big deal in the short term. But when you stretch them over 20 or 30 years, the gap in your total return can be life-changing. That is why picking the right fund is not about chasing the hottest chart of the week. It is about investing in something that keeps growing your money reliably over the long run. Before we look at our 5 candidates, let us go over a simple checklist. Once you know what to look for, the differences between these funds become very obvious. The first thing that matters is long-term growth. We are not looking at what happened last year. We are looking at how consistently a fund grows over 10, 20, or 30 years. Then we look at dividend growth. Even small annual increases can snowball into huge wealth when they are reinvested. Next is sector balance. Some funds lean too heavily into technology, while others spread out across healthcare, finance, and consumer goods. We also have to consider volatility. If a fund swings too wildly, most people will get scared and sell at the wrong time. If it barely moves, it might not build the momentum you need to retire comfortably. Costs also play a massive role. Lower fees simply leave more of your own money in your account to grow. Finally, we look for future alignment. Does the fund hold companies that are likely to grow in the next decade, or just companies that did well in the past? With that checklist in mind, let us look at the 5 most popular funds and see which one is the best choice for you. First on our list is the Schwab Total Stock Market Index Fund, also known by its symbol SWTSX. This is a fund you will see recommended almost everywhere. At first glance, it checks a lot of boxes. It tracks the entire United States stock market. It owns almost every publicly traded stock with solid data. If you want broad coverage, this fund absolutely gives you that. But when you look a little deeper, things get very interesting. Even though this fund holds nearly 3,000 different stocks, a huge chunk of its performance comes from just 10 names. Those names are the giants everyone knows, like Apple, Microsoft, Nvidia, and Amazon. Technology alone accounts for over 33% of the whole portfolio. So even though it calls itself a total market fund, it behaves a lot like a tech-heavy fund. Over the past 10 years, this fund has grown by nearly 200%. The costs are extremely low, with a yearly fee of only 0.03%. This makes it very predictable and easy for most people to hold. However, that predictability also exposes its biggest drawback. When you own the entire market, you also own a lot of slow-moving companies that barely contribute to your growth. The strongest companies at the top are always being weighed down by the weaker ones at the bottom. So while it gives you full coverage, that coverage can hold back your long-term performance. It is a reliable choice for simplicity, but it is not the highest potential choice. That leads many investors to look toward the S&P 500 instead. This brings us to the Schwab S&P 500 Index Fund, known as SWPPX. This fund trims out the weaker players and focuses on the 500 largest companies in America. It is straightforward, consistent, and backed by decades of reliable performance. Over the last 10 years, the total growth of this fund has reached over 214%. That is slightly better than the total market fund. The reason is focus. The top 10 companies make up nearly 39% of this fund. By focusing on large companies, you cut out the small, struggling names that held the other fund back. The costs are even lower here, at only 0.02% per year. For many investors, this level of predictability feels like the perfect balance. But even the S&P 500 leaves something on the table. By focusing only on giant companies, you miss out on the smaller ones that might become the next world leaders. You get stability, but you might give up a slice of the long-term upside. Now let us look at a fund that takes a completely different approach. The Schwab Target 2045 Index Fund, or SWYHX. This fund is built for people planning to retire around the year 2045. It uses what is called a glide path. This means the fund automatically shifts from aggressive growth to conservative protection as you get older. It is designed to be completely hands-off. Over the past year, it returned over 11%. It holds a mix of United States stocks, international stocks, and bonds. This design gives you automatic diversification that rebalances itself over time. This makes it very valuable if you want a simple way to create passive income by the time you retire. But this same structure is what limits its growth. Because the fund must follow a preset schedule, it cannot lean into fast-growing sectors when they are leading the market. It also cannot avoid weak areas when they are lagging behind. It is steady and predictable, but it is not built for peak growth. If you want maximum growth, you might look at our fourth option, the Fidelity Nasdaq Composite Index Fund, or FNCMX. This fund is a pure growth play. It is filled with technology companies, innovative businesses, and fast-moving market leaders. Instead of spreading out everywhere, it focuses on the parts of the economy where new ideas scale quickly. The performance numbers show why people love it. Over the past 10 years, the total growth has reached a staggering 319%. But that growth comes with a catch. This fund is far more volatile than the others. The swings can be very scary during a market pullback. It also pays very little in dividends. Almost all of your wealth comes from the price of the stocks going up, not from cash payouts. It fits someone who is comfortable with big ups and downs. But if you want a fund that blends growth, stability, and smooth compounding, this might be too aggressive. That brings us to the perfect choice for this year and beyond. The Fidelity United States Sustainability Index Fund, or FITLX. This fund checks every box that the other funds miss. It tracks an index of companies that are financially strong and well-run. Think of it as a broad market fund that filters out the dead weight. The performance of this fund is where it begins to separate itself. Since it started, it is up over 200%. Those numbers show steady growth without the extreme swings of a tech-only fund. The secret to this fund is the filter. It does not hold thousands of stocks just for the sake of it. It intentionally removes companies that are financially weak or poorly managed. By doing this, your money naturally leans toward high-quality leaders with strong balance sheets. It owns the giants like Microsoft and Nvidia, but it balances them with healthcare and finance leaders. The costs are low at 0.11%, and the fund is very efficient. The biggest reason this fund wins is its future alignment. It is built around durable businesses that are positioned to grow over the next decade, it landing right in the middle of being growth-focused but remarkably stable. Now, let us look at what this actually looks like for your future. Imagine investing just $10 a day into this fund. After 10 years, you are projected to have around $76,000. By year 20, that same $10 a day could grow to over $424,000. But the final decade is where the real magic happens. By year 30, your portfolio is projected to be worth roughly $2.2 million. At that point, your annual dividend income would be around $75,000. That is over $6,000 every single month in pure passive income. When you compare all 5 funds over 30 years, the difference is impossible to ignore. Using the same $10 a day, the lowest performer might end with around $890,000. But our top pick, FITLX, finishes at $2.2 million. The gap between the lowest and the highest is over $1.3 million. That is the power of picking the right fund and letting it compound. You have worked hard for your money. It is time to make sure your money is working just as hard for you. If you want a strategy that balances growth, income, and safety, this is the one. Choose simplicity, choose quality, and start building your future today.